They would literally just knock the shorts as being bottom feeders and evil or whatever. But they have a really important mechanism in the market. Shorts are incredibly important for creating bottoms, especially in times of stress. So I am curious, as you think about what it's like being a long short manager and the nature that you're a long short manager, which is different than, say, a ETF or mutual fund that has complete transparency and limitations to the short. A lot of times the shorts are rules based and these managers aren't actually making fundamental bottoms up selection of the shorts. Talk a little bit about what that is like and the difficulty of it and how you have been able to succeed in an area that is fundamentally hard. The market goes up way more than it goes down.
Yeah, yeah. So you're absolutely right. Everything is structurally working against you when you short. Companies have every incentive to move in a different, they might get their stock moving in the opposite direction for compensation purposes, obviously, and job preservation purposes. The South Side is just chronically incented to be bullish. And you're right, the market clearly generally lives with growing economies. And so you do have everything stacked against you right out of the gate. There's a lot of different ways to short. One thing I've learned that we're doing over the last 25 plus years is that you do have to adapt in terms of how you approach it. Now, we've been quite successful on the short side. We run actually consistently good alpha on the short side, even more consistent than we do on the long side, which always surprises me. But when people talk to us about our short ideas, they're often very surprised about how it gets done. There's this concept and this view of a short seller being some sort of swashbuckling approach to finding frauds and accounting irregularities and making 50, 70, 90% on a short. That does happen. That is out there. That's the sort of the picture of the shorts. That being said, that's not how really most of it's done. It's certainly not how we do it. Our shorting is very pedestrian. People, when we go through our short ideas with people, are like, that's a really boring idea. And actually, boring ideas really work in shorts. But since everything is stacked against you in shorts, when you're looking for those quote home run type shorts, those frauds, those accounting irregularities, that type of thing, what you find is one, they're very crowded names. There's not a lot of great short ideas out there. There's not a lot of companies that actually fit that parameters. Our markets are efficient enough that they flush a lot of that out over time. Now, there aren't a lot of those type of names, and they tend to be very crowded, and they tend to be very binary. And to be successful on the short side, even more so on the long side, it is more important to control your losers than making winners. As important as on the long side, it's even more so on the short side since everything's stacked against you. And since you theoretically have no cap loss being short. So as a result of that, those high quote profile names, they're crowded. They tend to be binary. When you get them wrong, you really get them wrong. They're prone to short squeezes. They're prone to the meme stock mania that started sort of January of 21, which was a sea change in how you had to approach shorting. So we find that singles and doubles on the short side, quote, boring pedestrian ideas, is really the way to make an all-weather type short portfolio. And so the best shorts tend to be decent companies, even sometimes really good companies that at the margin for some competitive or secular reason are getting worse.
Mhm.
And that usually is enough to make a good short return on the stock while avoiding a lot of the pitfalls and risks. They're not highly shorted names, so the management's not out there pushing against you. The sell side's not pushing against you. You're not, borrow rates not expensive. The borrowers are not getting tight. You're not risking getting called in on a borrow. If you're long, you're not getting squeezed. So it's much easier to control your losses. If you can control your losses on the short side, you'll generally do pretty well over time.